Okay, so last session we valued bonds, and so in this session we want to move from bonds to stocks. Now, there are some other videos on valuing bonds that look more like what's on the exam, and so we'll work through those, especially when we do a team question on that. So we will look at a couple more bonds as practice. But moving into stocks, we go through this 5-step process. We got to forecast the cash flows, get a discount rate for the stock, get the discounted value of those cash flows, get the value of the stock, compare it to the market value, and then make a decision. So forecasting cash flows for bonds was real easy. For a bond, we just took the face amount of the bond, multiplied by the coupon on the bond, and divided by 2 because they pay twice a year. For stocks, there's no cash flow. That's contractual. There's a cash flow, but it's not contractual. It's whatever the firm decides to pay. It's the dividend they pay on the stock. It could be zero for some companies like Alphabet or Amazon or firms that just don't pay dividends. It can be a huge dividend, such as for real estate investment trusts that pay large dividends because of the tax law. It just varies. And then even if we know what the firm's dividend is today, we don't know how fast that dividend is going to grow over time. And so you'll see we're going to work on this when we do paper 4. Paper 4 is the valuation of a stock. Paper 3 is coming up with a discount rate for the stock. We talked about that when we talked about beta and the market risk premium and the risk-free rate. But paper 4 is actually valuing the stock. And the hardest part about paper 4 is figuring out the growth rate for your firm's dividends. What I recommend is that you start with how fast you think the economy is going to grow. Remember, we used economic growth when we were coming up with the market risk premium for stocks. We used the implied approach, which was the current dividend yield for the stock market, plus how fast we thought the U.S. economy was going to grow. And we said, that's going to range anywhere from 4 to 6% would be most likely for most people. After you look at the economy, you might want to look at your industry that you are in. There's something called Porter's 5 Forces, which I hope you will have in some class. When you have Porter's 5 Forces, pay very close attention. It's an extremely important function in finance, very important theory in finance to make sure you understand this concept of buyer power, supplier power, barriers to entry, threats of substitutes, rivalry within the industry. So there's some industries that are set up to have strong, continuous, sustainable growth, and there are some industries that are just at the end of their product life cycle. They just cannot grow much faster because they've already saturated their market. The demographics of their customer base is not growing. They're not growing overseas. So you want to look at the industry. This concept of economic moats really works well when you're thinking about growth, especially looking at the company, but also at the industry. Economic moats is when you have a sustainable competitive advantage, so you can have above average growth and competition doesn't come in and steal that growth away from you because you have something, whether it's a patent or maybe it's your customer base is so large it gives you an advantage. So there's definitely a lot of concepts there that can influence what you think the growth of a company or an industry will be. And then you look at your individual company and you're asking, okay, if it's in an industry that's growing fast, maybe it's growing faster than the overall economy, then what is its market share implications? Is this company taking market share from other companies? Is it growing faster? Was it the first one in the market and now it's a fast growing market? And when you have a platform business like a Facebook or a Google, if you're the first one and you have large numbers of customers, you can have sustainable growth because your customers come to you because you have all those customers. People go to Facebook because Facebook has over 1 billion users. So you're more likely to find someone you're looking for. And advertisers come to Facebook because they already have over 1 billion users. So that's a sustainable competitive advantage. That means your firm is in a good industry and they have something unique that helps them grow faster than everybody else. We're not good at forecasting, but that's what you have to do to value a stock. You have to go out 20, 30, 40, even 100 years of some of these companies to really get a good growth rate for them. I'm going to walk through this when we do the example of papers 3 and 4. I'll walk through an entire example. Just real quickly, what you're going to need in paper 4 are two growth rates. You need a long-term growth rate, which is the growth rate of a firm after they have maybe their current fast period of growth. Maybe you have someone like Alphabet or Amazon that are growing really fast right now. But their ultimate growth rate, what will it be? And that's, I usually say for most firms, use whatever your growth rate is for the U.S. economy, use that as your long-term growth rate. But then short-term, a firm can grow at a much different speed. And so there's three approaches I'll walk through. One approach is to look at how fast their earnings have grown in the past. Look at their rolling 3, 5, and 10-year growth rates. Some students do this on paper 4, but now that we don't have access to Bloomberg, you really can't pull these numbers, so approach 1 is off the table. Approach 2, we'll talk through approach 2, but approach 2 uses what's called the PEG ratio. And what the PEG ratio is essentially the PE ratio of the firm. We'll talk about PE ratios a little bit more later in the class. The PE ratio is the firm's price per share divided by its earnings per share. The PEG ratio is the PE ratio divided by the growth rate that the market assumes over the next 5 years. So if you have the PE ratio and you have the PEG ratio, you can figure out what is the growth rate that the market expects over the short term. So your expected growth would be your PE ratio divided by your PEG ratio. So I'll give you an example. Let's take Alphabet. Let's say Alphabet has a forward PE ratio. You want the forward PE ratio. You can get that off of Yahoo Finance. Just click on statistics. Give you a forward PE ratio of 21.53. Their PEG ratio is also in Yahoo Finance. It's 1.34. I'll show you more of this when we do the example of papers 3 and 4 in class. So Google's expected short-term growth rate would be their PE ratio of 21.53 divided by their PEG, or 16% over the next 5 years. And then the last approach is the textbook approach. I'm not 100% sold on this, although I think it can have some basis in reality, but what's called the sustainable growth rate or the sustainable growth model. And what it says is a firm can grow equal to its return on equity times how much of its earnings it retains. So if a firm has earnings per share of $4.74 and dividends per share of $1.59, so they make $4.74 and they pay out $1.59, then they're retaining $4.74. I'm sorry, they're retaining, $3.15. Sorry, I jumped ahead. So if they make $4.74, they pay out $1.59, then they are retaining $3.15. $3.15 divided by $4.74 is 66%. So if a firm's return on equity is 10% and they retain 66%, then their short-term sustainable growth rate is 6.6%. You can get return on equity from Yahoo Finance. You can get the actual payout ratio for the firm. The payout ratio is $1.59 of the dividends divided by the earnings. So that gives you the payout ratio. So retention is nothing more than 1 minus the payout ratio. And the theory here is that firms that retain more of those earnings should be able to grow faster than firms who pay out a lot of their earnings because they're reinvesting in their firm, doing more capital expenditures or CapEx. And so that's the theory. At least in the short run, that's what they should do. This formula is probably correct long term. It makes sense, but it assumes return on equity and retention are constant over time, and they're not. There's other things going on. If you look shorter term, if you actually do a regression of growth rates and retention rates, you would notice that there's not a positive correlation. There's actually a negative correlation. Firms actually pay out more when they're growing. It actually retain more when they're growing slowly, and they retain less when they're growing faster. But I think that's a short-term phenomenon. When firms are going through a crisis like they are right now, or like in 2008, their earnings are growing slowly, and they retain more because they're scared to death. They're not retaining because they have great reinvestment strategies. they're retaining because they're scared to death and they're just clinging on to their cash. And when firms are growing fast and doing well, they may actually pay out more in dividends because of their confidence in the future. They feel confident they can pay out the money because the stock market is strong and they can issue stock if they need it. And so short term, when you look at year by year by year, there's actually a negative relationship between retention and growth. So I think this is more of a long-term theory that firms should be able to grow in line with their return on equity times their retention, but more long-term factors. And then you have to think about the timing. If your long-term growth is going to equal whatever the growth of the economy is, and your short-term growth might be using the PEG ratio or using the sustainable growth formula, then how long does it take to get from that near-term growth to that terminal growth? For some firms like Campbell Soup, you might already be there. Campbell Soup may already be at its terminal growth rate. They're just a mature company. You might even say that about a Walmart even. Although Walmart's still building stores and still growing overseas, they're still not in a hyper growth period like an Albertson or like an Amazon or a Alphabet. All right, so there's a growth rate discussion. Trust me, when we get to papers 3 and 4, I'm going to go through this in detail and show you exactly how to build this for a company of your choice. So we will get to this. The only thing you will not be able to do is this approach number 1, just because we don't have access to Bloomberg right now. All right, I already talked about the discount rate. I'm going to skip that here. But we'll go, when I do the example of papers 3 and 4, I'll go back through this again in detail and show you what you can do for all your assumptions there. So what I want to do in our next session, I'm going to stop it here at about 12 minutes. What I'll do in our last session for today's class is actually do some valuations using 3 models: the dividend discount model, the capitalized earnings model, and the H model. Those are the 3 models you need to use on papers 3 and 4. So we'll do that in the next session, and I'll walk you through. They're fairly simple formulas. The hard part is getting the assumptions. Once you have the assumptions, plugging them into the formulas is fairly straightforward.